All right, how many of you guys have heard of Ramit Sethi before?
Who is that?
I just recently saw his Netflix show. It was great. There's some good things I liked about it, and there's some things I maybe didn't agree with as much. But I've noticed he's kind of like the Dave Ramsey for millennials, isn't he?
Oh my God.
Well, I want to talk about a video here that I'm going to share that he was talking about 401ks and what you should be doing with that. Because the question is, should you be loading up your 401ks? And when should you? And how much should you be putting in your 401ks? So I want to kind of hear what his advice is, see what is here, and maybe what I would add to it or agree with, but maybe something I might say would be completely different. So let's just take a look here.
If there's one thing we love in America, it's not to keep up with the Joneses, it's to do better than the Joneses. I got a question saying, why should I not invest in a 401k? And I want to answer that for you because there's two key reasons you would not want to invest in a 401k. First, you hate money. I don't like money. I don't like free tax benefits. I don't want it. Get this out of here.
Okay, I just love that one. It's like, I hate money, you know. Now, free tax benefits, I'm kind of curious what he's having to say about that one because that's a lie.
Get this out of here. Second, you're a billionaire. No reason to, not even worth the time. And that's about it. Your 401k is a terrific investment vehicle for you to benefit from legal tax advantages. And if you have the opportunity, you should do it. And even better,
I wonder what those legal tax advantages are. Let me talk about that because he talked about tax-free and stuff, which that's not true. Well, actually, let me go back. Let me just make sure he didn't actually say tax-free here. He did say it is.
You would not want to invest in a 401k. First, you hate money. I don't like money. I don't like free tax benefits.
Free tax benefits. Okay, so he's saying there's a tax benefit here and it's free. Okay, so he's not saying tax-free benefits, which is good because that would make me worried. But here's the thing, what's the tax benefit of a 401k? Now, if you really look at it, a 401k really, it's tax deferred and really it's tax delayed. Yes, you put money in before tax. You get a tax deduction off of it. But really what you're doing is you're getting an income deduction. You're getting income deferral to a later date. This implies, of course, that you're gonna be in a lower tax bracket in the future, otherwise this doesn't make sense, right? So assuming you don't have any write-offs, assuming you don't have kids, assuming you don't have mortgage interest and all the things you're writing off, you should be in a lower tax bracket, right? Well, that's not what he's saying. He's saying that there's great tax benefits, take advantage of them. Well, really, what I've noticed is it's just delaying your income to a future date because you gotta pay the full-on income tax down the road. The question you have to ask yourself is, do I trust the government will reduce my taxes by that point? Or maybe will I be broke enough because this didn't work for me that maybe I won't have enough money to pull out anyways and I will be in a lower tax bracket because I'll live on a worse lifestyle than today. So he's essentially assuming if that's the case, well, then I fail. I failed at that 401k. But anyways, I don't know. That's it's interesting to kind of hear him say that.
Employer matches your contributions. You should stop watching this video right now. Close all your computers, close everything, call up HR and start it right away. So if you want to know what you should have,
call them now. Do it. Call HR.
Hello? Hello? Who is this?
Okay, well, that's great, but I'm glad he loves his 401k. Well, let's hear more.
Should have in your 401k, you should have maxed it out every year since you were 22. Most of us didn't do that. That's okay. The next best thing we can do is to take full advantage of it from here on out. Now, of course, you should be saving up for an emergency fund. It's going to take you a while, but I recommend you aim for having 6 months of minimal expenses in your bank account. Now, when it comes to investing your money, that's money you don't need in the short term, but it's there to grow over the long term. This is what you do. I have something called the ladder of personal finance, and this is how it works. If you get a 401k match, start there and contribute everything you can to hit that match. Next, pay off any debt you've got. Contribute to your Roth IRA if you're eligible. If you still got money left to invest, go back to your 401k and fill that thing up. And then finally, if you've still got money, you're doing very well, create a taxable non-retirement account and keep investing there in low-cost long-term funds. That is how...
Okay, so that was pretty much the end of his advice right there on his ladder strategy. That's great. Now, one thing I want to bring up too, he kind of mentioned about debt. I would say this, even before you start putting money in and even getting the match on your 401k, I would focus on paying off debt, especially if it's keeping you paycheck to paycheck. If you are paycheck to paycheck right now, I mean, it's great to kind of look at your expenses and see what you can do. But if your expenses, some of that's debt, look at paying that debt down. Specifically the debt that has a higher payment with a lower balance. I call this the cash flow index, where you take the balance of the loan divided by the minimum monthly payment, and that gives you a number. The lower the number, the more you want to pay it off, especially if that number is below a 40. Now, if you're to put this in rate of return standpoint, right? Because some people will argue saying, well, yeah, but if I get that match, I'm getting more money. That's giving me double my money right there. Shouldn't I do that? And there's an argument for that. But remember, a 401k is money out of your pocket that does not affect your day-to-day living. I know even Ramit would say this, at least one place we can agree, is that he would say that your cash flow, your monthly cash flow, make sure that you're not paycheck to paycheck, fix that first before you try to worry about putting your money in a 401k. Now, of course, he's gonna want you to do both, right? But you do wanna fix that cash flow first. And one of the best ways to do that is actually getting a guaranteed return that affects your monthly cash flow month after month. That gives you more options. That means you could put more money in your 401k if you so chose. But I personally wouldn't want to do that. I think it's really interesting too that, a lot of times he'll say like, don't leave money in the banks, right? Like don't put in this bank account, don't let it stay here, because you're gonna lose to inflation. Well, the problem is what happens if the market drops? If the market goes down like 20% like it did in 2022, inflation still went up. So not only did you lose 20%, but then you lost into inflation as well, which inflation, even though they said it was around 7-8% in 2022, we all know differently, right? We know it was a lot more than that. The government underestimates those numbers so that they don't have to keep raising Social Security. So let's just say it was 10%. So that means it went up 10%, you went down 20. So let's just say you're talking about $100 here, and then all of a sudden your $100 is worth $80. But now you have to have $110 to make up for it. Well, the next year, let's just say that inflation only goes up 5%. Well, now that 110, now you need about 116 bucks. Well, again, if you had 80 bucks in here, you have to get up to 116. That's a $36 gap. That means the market has to produce, for you just to get back to breaking even on inflation, you have to make almost a 50% rate of return to get back there again. This is why people like my dad, baby boomers, suffered so much max funding and putting in their 401ks. And he's even saying, after you do the Roth IRA, keep putting money in max fund and just go all out into your 401k. Keep putting money there and then even move it to other non-retirement accounts and other indexed funds, right? He's just saying put everything in the market. He's even said in other videos and whatnot, interviews, that he does a 70-30 split, 70% stocks, 30% bonds. I'd be curious to know how his portfolio did because guess what? Bonds lost money last year too. So he would have lost money either way. Is he still telling people, oh, it's a great deal. It's okay because you just ride out the wave. It's a long-term thing. Don't look at it. Set it and forget it, which is exactly how people lose money in the first place is, you know what? I just gotta cover my eyes, not look. It's just like being on a roller coaster. No, you don't. No, that's not how it works, guys. The best thing to do is to not lose money. Protect what you have, make more on top of it. And so, yes, you can pay down debts. That's a great thing to do, but I would rather invest in better things. It's not bad to have money in a savings account, although it's not producing great results right now. Instead, you could do something like infinite banking. You can actually do something with that, especially if it's set up the right way, not the traditional way that infinite banking is set up, but the better way. That's a max ROI. You can actually be earning a much higher return than in the bank and be able to help combat inflation tax-free. In the meantime, building up that portfolio so then you can actually start to invest in other things that do make more money, have been proven to make more money, like real estate investing. The thing is this, guys, is that I was able to retire twice before I was 59 and a half. I didn't put my money into 401ks. I used to. I did that early on in my 20s, but I cashed those things out when I realized I didn't want to wait till I was 60. I wanted to be able to have the option to retire now and not lock myself in a plan where I had no wiggle room. I didn't want to lock myself in, especially if they changed the age from 59 and a half to 62 or 65 or whatever the government felt like making me retire at. France is dealing with this right now. There's a huge political backlash and protests going on because they want to raise up the retirement age just a few years. People are like, no, you can't do that to us. It can happen to us as Americans too, guys. Don't think that this is not going to happen to you. Anything can happen. They can make their decisions, whatever they want. And remember, the government is like the house in Vegas. They need to win. They have to win. They need to win because they're going broke. They got to find other creative ways to make money off of you. That means they could change the rules on you. So overall, good, vanilla, traditional mainstream advice that you hear from Ramit. I think overall, I like a lot of his advice. But much like Dave Ramsey, when it gets to investing, not so much. I think you can do much better. I would invite you guys, keep watching. There's a better way to do it. In fact, this next video right here is Dave Ramsey looking at Graham Stephan's portfolio, which is similar, closer to like what I do. You should check out to see what Dave Ramsey's reaction is to that one.